GTA home buyers and home buying hopefuls are all asking the same question right now. Will home prices continue to crash or correct? I think that we're asking the wrong question, though. I think that we should be asking, how long will the current correction we are in last for? Will it be quick like we saw in 2017? Or will it be more long and drawn out like the lost decade of the 1990s? In this video, we're going to jump into comparing the most recent four market corrections in the GTA. We're going to look at what economic indicators look like at those times, and we're going to compare some global corrections from different markets to what we're experiencing in the GTA right now in an attempt to answer some of these questions. Hey, if you're new here, my name's Rob Marsiglio. I'm a realtor in the Greater Toronto Area. Every week on this channel, my goal is to break down what is happening in the market for you. So if you're into data-driven insights, hit the subscribe button, like this video for more content just like this. And if you want to book a call to navigate this market together, there is a link in the description below. Let's start off by taking a look at the current correction versus the previous three corrections that we've seen across the Greater Toronto Area. This chart encapsulates three of them all together. There's March 2022 going from our peak of $1.3 million to the trough so far, which is October of 2024, where that benchmark price hit $1,060,000. Just that you're aware, I'm pulling this chart directly from the MLS Home Price Index from Korea. Prior to this correction, you go back to April of 2017 when we saw the benchmark price across the GTA peak out at $850,000. It then corrected pretty sharply right to December of that year, and then it ended up bottoming out in January of 2019. And prior to that one, you have to go back to the global financial crisis. That was April 2008, where we saw the benchmark price drop in a matter of 10 months from $377,000 down to $345,000. Now, the Korea benchmark price, this home price index, doesn't go back as far as the correction that we saw in the late 80s through the 90s, so I pulled those stats directly from the Toronto Regional Real Estate Board. Here we are looking at the annual average prices from the Toronto Regional Real Estate Board starting in 1979, and the chart goes all the way through to 2002. You can see that the biggest run-up occurred in the 5 years between 1984 and 1989, where we saw prices actually increase by 167% in those 5 years. It then took 7 years to find the bottom in prices. It was a 27.7% drop that we saw, and then 6 years to recover to that nominal price that we saw in 1989. So that didn't happen until 2002. But a quick note, it actually took until 2010 for us to see real house values get back to the 1989 levels. So I think those are useful visuals to see how prices trend on that line chart, but I want to run through the numbers more specifically with you in terms of the run-up percentages, the time to the peak, time to the bottom from when it started, the correction of the crash, what triggered that crash, and then really how it ended in these previous corrections. And that's where this table comes in handy. You can see that in the 89 to 96 correction, we saw that 167% run up in 5 years prior to the peak. We then corrected 27.7% in 7 years. The trigger of this correction was high rates and speculation. Does that sound familiar to you and the situation that we're in right now? How did this correction kind of end? Well, the economy really stabilized, then rates came down, leading to some more buyer confidence and spurring the market back on. In 2008, 2009, this is the global financial crisis, and there's really no major run-up in prices if you go back to that chart and look at it. Time to peak, we're calling it around 8 years. It was just a smooth run-up from 2000 to 2008. Then we saw a correction of 8.5% over the 10 months that followed. So that's from April of 2008 to February of 2009. Obviously, we said the global financial crisis triggered this event. And how did it end? There were aggressive rate cuts on the part of the Bank of Canada. In 2017, we saw a 40.4% run up in just a year and a half leading up to the peak. Then prices corrected 12.7% from really April 2017 to December of 2017. All told, when things really finally bottomed out in January of 2019, we saw prices come down by 12.9%. So that all took about 2 years, we'll call it. Policy changes in the stress test, that's really what triggered this massive correction. I'm not sure if you remember, it was really Easter long weekend in 2017 that we saw the market, just the bottom fall right out of it, especially in places like York region, Peel region. Toronto wasn't affected quite as much. But how did this end? Demand rebounded because of lower rates. And now to the correction that we are still currently in. We're going to call it the 2022 correction till TBD. It was a 61% run up in prices over 2 years. Then we saw prices drop by 19% really from March of 2022 to January of 2023. Time to bottom, I have ongoing as a question mark. Have we hit the bottom? We're going to try to answer that question a little bit today. This was triggered by high rates. There was an affordability crisis because of those high rates, and then a ton of speculation, probably more so than we've seen in any prior housing correction. How will this one end? We're uncertain, but we'll try to get some answers as to scenarios and how things may play out at the end of the video, so stick with me right through to that one. So quick summary, we'll break it all down. 2017 was quick and mostly policy driven. 2008 was global financial crisis, where Canada got away relatively unscathed thanks to the kind of health of our banking sector. We didn't see big bank collapses. 2022, from my opinion, and looking at these charts, really most resembles that 1989 through the 96 correction, and then that slow recovery. Let's take a look at what the economic indicators look like over these time frames and see if this kind of backs up our theory that we're probably most similar to that 89 to 90s correction. So here we go. Interest rates, definitely the highest in 1989 when that correction started, in that 12% range. You can see that in 2008 and even 2017, rates were relatively low at this time. 2022, rates reached 5% at the top of that rate hiking cycle, which really happened as we saw prices falling. Inflation, 89 very high, 2008 through 2017, relatively low inflation, kind of within the bounds of what the Bank of Canada was expecting. Then again, 2022, we all know that inflation has been kind of a recurring theme. It's come down now, but at the time of this correction starting, inflation was definitely getting away from us. Mortgage arrears, they were rising in 1989 and rising in 2022, while they stayed pretty low through 2008 and 2017. Household debt levels are much higher now than really any prior correction that we saw. It says high here in 2017, but again, it's record highs for the last couple of years in the Greater Toronto Area and Canada. Immigration, this is maybe a bull case. It's a bull case that I'm hearing, that we have record high immigration to really prop this up, whereas in 1989 through the 90s, immigration numbers were much lower. Unemployment rate was a lot higher in 1989. We're still at around just over 6%, the unemployment rate across Canada right now. TD projects this to kind of maybe go up a little bit more and then crest over and start to fall off. Will that be the case? I think it's going to be a big driver in determining what happens going forward. And then condo speculation, another major factor in 2022 that we really didn't see in any of the prior corrections. Yes, we had some speculation, definitely in 2017, definitely speculation in 89 through 96 as well, but not condo speculation necessarily. And we'll kind of touch on why that might make things a little different this time around than we've seen in the past. Now, I touched on the argument that immigration may be a bull case, and I want to just run through some of the talking points that maybe bulls and bears, what I'm hearing from them. So first from the bulls is that, again, immigration's at record highs, more buyers will keep demand strong and prop up prices. Unemployment is still low relatively, so without job losses, we won't see forced sales really flooding the market. And then interest rates may continue to drop at a rapid rate, improving affordability and really putting a price floor on the market. So that's kind of what the bulls I'm hearing from them. On the kind of bears side, the more bearish tone, household debt is higher than ever, so we touched on that. Something really has to give in terms of this household debt. Mortgage renewals will hit homeowners hard. We are seeing a wave of mortgage renewals, people locking in cheap mortgages through the pandemic and prior. Now rates are much higher than they were at that time. So this renewal shock, will people be able to keep up with the payments on their homes? And then we haven't seen the worst of the economic slowdown quite yet. Job losses could still come. We're going to have to probably deal with some fallout from tariffs, maybe spiking the unemployment rate there. So that's kind of what I'm hearing from the bulls and the bears at this time. And I do think that both sides make valid points. I think I might tend to lean towards kind of what some of the bears are saying right now, in the sense that I do believe we're in for a bit more of a longer, drawn out correction. I'm not predicting massive price crashes imminently right now, but economic indicators are still pointing more towards the bearish side. I think it's just kind of trying to compare what's happening in our market right now to what we've seen in the past from other markets and what we can learn from them kind of on a more global perspective. And I really want to hone in on the Irish housing market collapse of the kind of late 20 noughts, and then the Japanese housing market correction that we saw in the 90s as well. And no, before I go on, I'm not forgetting about the 2008 collapse in the US and what we saw down there, but there are reasons that I don't feel like it's going to shake out the same here as we saw down in the United States. Although, it's not out of the question, but here's some key differences in terms of what happened in the States versus what's happening now. So the trigger there was the subprime mortgage crisis, whereas here it's high interest rates, affordability crisis, speculations. Sure, there's probably some mortgages that shouldn't have been handed out to people that are going to affect, but not to the scale that we saw down in the US in 2008. In terms of foreclosures, we saw millions of people default on loans down in the States, whereas here in the GTA, we're still seeing few forced sales to this point in time. I do my kind of power of sale update on a weekly basis. Here's the most recent update there for what it looks like in the GTA. In terms of bank failures, we did see major banks collapse in the States, think Lehman Brothers, etc. Up here, we're still relatively stable from banks. So, if the banks go, that could be a big catalyst for a much more rapid decline in prices. Government and central bank response. So we saw bailouts, QE, and low rates in the US. Right now, we're seeing rate cuts as a response and some new mortgage rules from the government and the Bank of Canada to try to kind of soften the blow. And then the recovery there, it was a long recession that took years to get out of in the United States. Whereas here, we haven't seen a major recession yet, at least not a major declared recession in Canada. Although the economic indicators of recession probably don't match up to what you may be feeling as a consumer. The two other global real estate corrections that I alluded to are the ones that I want to get into next. And we're going to start with Ireland. Now, in Ireland, it was cheap credit and speculative investment that really fueled this massive housing boom. Home prices actually jumped 268% in the 10 years leading up to its peak. And then when the global financial crisis hit, Ireland's economy really did collapse. Unemployment spiked, banks pulled back lending, triggering a big wave of foreclosures and forced sales. So then you saw this 54% drop of prices in the 6 years following the peak before recovery started. And recovery was relatively rapid, as you can see here. Yes, it did take until 2022 to hit new nominal home price highs. But as you're going to see in moments, it's nothing similar to what Japan went through, which I feel like could be a little bit more of a comparable to what Canada or the GTA is going through right now. But again, this Irish crisis was really worsened by excessive lending and banking collapses, similar to what you saw in the States in 2008. Here's what happened in Japan now. So it was speculative real estate investment. Again, does that sound familiar to you? There's also a stock market bubble, again, fueled by aggressive bank lending, very low rates, extreme overvaluation of properties. And then when the government started raising rates to curb inflation, this bubble really burst. Banks, instead of foreclosing on homeowners, started extending loans, leading to a slow, drawn-out decline. So you can see that in the 16 years leading up to this bubble, prices jumped 178%. Then we saw a 47% drop over the next 18 years. So a much longer, more drawn-out correction than we saw in Ireland. Ireland was 54% in only 6 years. But it's been very slow recovery ever since. As of Q3 of 2024, which is as far as we get information here from via Fred here, the St. Louis Fed, we're still 24% off the peak values that we saw back in the early 90s. And again, weak economic growth and low population growth have really kept this recovery quite muted. So based on everything that we've gone through today, there are a few scenarios that I can see playing out. There's 6 different scenarios that I'm going to go through right now, and I want to hear what you think in the comments below as I'm going through them, what you think the most likely scenario is for the greater Toronto area housing market going forward. So scenario 1 is bank and government support and prices hold steady in this scenario. So we're going to say banks extend mortgage amortizations. We're already seeing some extended amortizations, but we're talking 40 to 50 years to prevent forced sales. The government introduces buyer incentives such as tax breaks, extended CMHC insurance. We've already seen, minimum down payment rules have been altered and changed to try to help affordability. And then in this scenario, we don't see prices rise, but they stay relatively stable despite some affordability challenges. Scenario number 2 is that rates continue to fall in 2025 and prices stabilize as a result. The Bank of Canada will continue cutting rates and affordability will improve. So more buyers will enter the market, but it's not necessarily a boom, just some price stabilization. Sellers still need to price competitively since buyers are going to be cautious, especially given everything that is surrounding us from a geopolitical and a kind of economic perspective. Think tariffs. Scenario number 3 is that rates stay higher for longer. Maybe the Bank of Canada has to hike rates all of a sudden. So it's a slow grinding correction similar to what we saw in Japan. Affordability remains weak, so sales stay low. Homeowners list out of necessity and increased supply. Prices trend downwards, but not in a crash. Just more of a slow erosion over the years. Now it's this back end of scenarios where we're going to see prices fall further. These are scenarios where I could see prices really starting to correct at a more rapid pace and for a more drawn out longer period of time. So scenario number 4 is the recession officially hitting. This is prices fall further, so job losses increase, forcing some sellers to list below market value. Demand weakens further, causing more supply to build up, and sellers who need to offload properties take bigger price cuts. And as we know, you don't get price corrections and price cuts until people have to start selling homes for much less than market value. And this scenario could really speed that up. Scenario number 5 is that investors sell off, and this leads to steeper price decline. So this has to do with the pre-con market, as we touched on. There's massive pre-construction speculation in this correction that we hadn't seen really comparable to prior corrections. So pre-construction condo assignments flood the market, creating massive oversupply. More investors offload properties due to carrying costs, especially condos, and prices fall sharply in investor-heavy markets, while freeholds are able to hold out for a little bit longer. And then in scenario 6, I think, is the worst case scenario: housing crisis and financial shock. This is large-scale price drops. It's a combination of high job losses, credit tightening, consumer panic that causes a deep housing correction. Banks pull back lending, maybe some financial institutions collapse, reducing home buyer demand further. Prices will decline significantly across all property types in the scenario. So again, let me know what you think in the comments below. What of these scenarios is most likely to occur? Do you think any of them will occur? Will it be a combination of a couple of them? What do you see housing prices doing in the GTA over the next, short term, let's call it next year, then 5 to 10 years? If you did get some value out of this video, I shed some light on the situation for you and maybe kind of highlighted some things that you should be keeping an eye on, please like the video and subscribe to the channel so you don't miss anything else going forward in the weeks to come. I thank you all very much for sticking with me right through to the end of this one. Until we speak again next time, stay safe and cheers.